Sanjeev, good morning. Thank you for joining
Right.
us. There is a silver lining out there, Sanjeev, that commodity prices have started reversing. Crude is down from its high. Should one read into it? Do you think now markets are getting reassured that bulk of the inflationary fear is behind us?
It's too early, but I would say definitely positive developments over the last night or so in the form of some recovery in monsoons. So now we're getting into normal monsoon territory, but we'll have to wait for another 2 months, to get more confidence on that. Same way, commodity prices have corrected a lot, especially metal prices, oil prices are moderated from high levels. So all that is good news, and raising expectations that inflation will not surprise negatively on the higher side. And in the second half of FY23, you will see a big decline in inflation, just because of very high base effect. Same time that the second half of FY22, inflation very high. So assuming we don't see any negative surprises on either food or fuel inflation linked to either subnormal monsoons or something going dramatically wrong on the whole Russia energy supply situation, hopefully inflation comes down, and because of that, you get some more confidence that okay, the RBI need not raise interest rates dramatically. Our own expectation is that by the time we exit FY23, inflation should be in the range of 4.5 to 5%, which means the RBI probably needs to raise rates another 60, 85 basis points from where we are. So 5.5 to 5.75 is the as of now the limit that we're looking at as far as policy rates are concerned, which is pretty manageable in the context of the fact that from the bottom of the cycle, you're looking at about 150, 175 basis point rate increase. Similar transmission if you assume for interest rates in general. I think the impact on the economy is pretty limited in that case.
This challenging macro environment, where the micro of the market has become better, where do you think, while we can focus on interest rates, inflation, commodity prices, the micro is looking good now?
See, if you look at parts of the economy, especially urban poor and the rural economy, which were quite badly affected by COVID, because these are typically people who are employed, in high contact or physical sectors, a combination of construction, hospitality, retailing, travel, tourism, transportation, etc. So there, just because reopening and economic activity rebounding, you are starting to see income levels, if not go back to pre-COVID levels, at least, being significantly higher than what they were during, the grim days of the lockdowns or shutdown. So clearly a lot of recovery over there. On top of that, you have seen a fairly smart recovery in food prices linked to both global prices as also domestic fruit vegetable prices gone up pretty sharply because of seasonal factors. So it's contributing inflation on one side, but clearly it's positive for the rural, especially the agri part of the rural economy. So clearly things have improved over there. Over the last fortnight, because of commodity prices cooling off, particularly metal prices, that's clearly a big positive for autos, which consume a fair amount of metals, as you know. And you have seen, significant rally in some of the auto names linked to cooling off of metal prices and also oil prices to some extent. So those are the segments where, at least the micro seems to be getting better, linked to the macro factors also.
So then taking that forward, Sanjeev, good morning. This is Nayantara. So if all of that is getting more favorable, can I ask you specifically about how one should approach FMCG? You take ITC out of the equation, FMCG stocks are what? Down 15 to 30%. Now commodity prices are also getting softer. Is there an opportunity here?
See, from a valuation perspective, the stocks are still very expensive. That's the problem. So if you compare the multiples on a 12-month forward basis for any of the consumer staple names or even discretionary names, let's say March 19, which was a similar, macro environment, similar levels, the bond yields, etc. Multiples are pretty much at the same level, if not higher in some cases. For example, if you look at Asian Paints, Marico, Godrej to some extent, in fact, multiples higher compared to March 19 levels. So it's not as if you have seen a big correction in the multiples. What you have seen is some correction in stock prices from peak levels, but there the valuations had become totally absurd, in that February, March, April time frame. So yes, valuations and prices have corrected, valuations have come off, but I don't think they have gone to a level where you can make a strong, buy case for the companies. They just got back to, as I was saying, March 19 levels. So I don't think, I can take a very positive call on the consumer names linked to valuation at least.
Okay, so you're still finding FMCG to be expensive. Sanjeev, I was reading a report you had put out on June 24th where you found broader markets to still be quite expensive, especially if you were to look at the bond markets, the hints that you would get. Can you explain more to our viewers why you're still not impressed with the valuation of broader markets and when you will wait, what kind of levels you will wait for to become a buyer?
So if you look at the broad market Nifty, let's say 50 index, that is somewhere about 18 times on a 1 year forward basis. So clearly a lot more, reasonable, I would say, compared to somewhere about 20 to 23 times, which was trading, in the second half of calendar 21. So yes, multiples have come off. But the problem is bond yields have gone up pretty sharply over this time frame, from less than 6% to now closer to 7.5%. So the challenge still remains that if you look at the gap between earning yield and bond yields, and when I say earning yield, that is nothing but the inverse of P, that is E upon P on a 1 year forward basis. So that gap is still on the higher side. If you look at your, let's say your 10-year ESIC is about 7.5% or 7.4 as of now. And your earning yield on a 1 year forward basis would be somewhere about 5.5%. That is 1 upon 18 times. Yeah. So that gap is somewhere about almost 200 basis point, 190, 200 basis point, which historically we have seen is on the higher side. I'm talking about negative side, that is. And if the yield gap is so negative, the markets will struggle to perform. And from here on, hopefully there's not much risk of bond yields going up further, assuming we're right on the inflation part and things have pulled off. Inflation more or less peaked. Well, having said that, you still have upside risk inflation, but assuming that's the trajectory of inflation going forward, hopefully you won't see any negative surprises on the bond yield part. Do we see any positive surprises on earning yield part? Looks unlikely. I don't see earnings upgrades happening at this point in time. So the only way this market could go back to more normal levels of yield gap, that is between earning and bond yield, could be through a process of either time correction, and hopefully that is what plays out, or through a price correction, which obviously means there is downside risk to the market in that case. So let's see. Our view is that if inflation more or less peaked and inflation starts coming off in the second half linked to base effects, no negative surprises on food and fuel inflation, then it looks like most of the bad news is there in the market. Valuation is still not very attractive, but at least I think there could be some bottom for the market at current levels.
Sanjeev, hi, Aisha as well joining in. One is pretty split and divided when it comes to IT. I was just chatting with Nikunj before the show that IT stocks from the pre-COVID levels are still, 60% higher. Having said that, valuations are still exorbitant, even though IT was the first to crack in this, global market sell-off, which India also has been part of. That said, all the chatter and murmur is still extremely strong. We just heard from the, on the sidelines of the Infi AGM over the weekend, or the Accenture guidance as well. All the demand parameters and levers seem to be just so strong, but IT stocks don't seem to be performing. Having said that, valuation-wise, they've still not cooled enough. So which part of the camp do you go for when it comes to IT?
Maybe I have more or less a neutral view on IT as of now. Neutral to slightly underweight, I would say. See, on the positive side, yes, demand is looking good, but you also have to contend with a possible slowdown, if not recession, in the US. And as of now, most people are of the view of that you will see probably a recession in the US sometime in 2023. So that will definitely weigh on demand for IT services. The bigger challenge in that case would be also margin pressure. because if there is a recession, and God forbid, hopefully I'm wrong on that one, but if there is one, then I don't think IT companies, that is the buyers of IT services, will be in a big hurry, to close deals, etc. They will take their own sweet time. They will negotiate the hardest they can. Squeeze margins of the IT service providers to the best extent they can. So you will definitely see some margin pressure coming in. How much of that is offset by the rupee? Time will tell. But I definitely think even if there is not a big cut on the top line of the IT company, the bigger risk is more coming from the margins, assuming this whole recession scenario actually plays out in the US. The second challenge for the IT companies is valuations have corrected pretty sharply from March levels, but they have not gone to level, where again I can be very comfortable about valuation and all the negative news getting priced in. If you look at in fee, for example, this was a stock which used to trade at about 15 to 19 times on a 1 year forward basis. That's on a pre-COVID time frame. Currently, it's still somewhere about 24 times on a 1 year forward basis. Maybe the pre-COVID multiple is not correct because at that time there was a lot of negativity associated with the IT sector in general and in particular with the Infosys stock. So maybe that 18 was not justified. Maybe it should have been low 20s, but we are at 24. So I think we still need some correction over here. Hopefully, again, time correction. And assuming stocks don't go anywhere over the next 6-9 months, which I suspect will be the case for the market also, I think in that case, multiples may start looking a lot more, palatable after a period of time correction.
Sanjeev, the other interesting thing, what one is seeing, and that's only a very recent phenomena since last week, is this massive revival in autos. What was restricted to farm equipment majors like M&M scaling new highs, now the buying seems to be spreading across the Hero Motorcorp, Bajaj Auto, where the street is finally excited about the buyback meeting happening today. Just wanted to get your thoughts in. And of course, Maruti as well, which is now finally, scaled at 8K per share mark.
Yeah. I think it's broadly linked to both top-down positive developments in the form of sharp crack in metal prices, which is obviously good for profitability of the auto company, because obviously, at those levels, that is, let's say, a month back levels of metal prices, auto companies are seeing a lot of pressure on gross margins and profitability. So that fear has now gone away. So clearly a big positive in the form of not that much negative impact on margins as what the market was fearing, let's say, a month back. Oil prices have also come off, although it doesn't matter that much in Indian context because we haven't changed prices for a long time, but at least the worries about big increase in pump prices, etc., has probably receded, which is also material because ultimately the whole cost of ownership matters as far as auto demand is concerned. So clearly positive tailwinds arising from commodity price correction. Plus, you have specific bottom-up developments in some of the companies which you already highlighted. In the case of Maruti, for example, there's a lot of excitement around the new Vitara Brezza launch, that is, or the facelift of that, and hopefully that will result in Maruti regaining some of the lost market share in the SUV segment. We'll see, how that plays out, but that's what the market seems to be focusing upon as of now.
Right. Sanjeev, great to have you on the show today. Thanks as always
My
for
pleasure,
speaking with us.
Thank you. Bye.